Good afternoon and welcome to today's Investor Spotlight event featuring 4 companies ready to present an overview of their investment case and why they believe their company is an attractive opportunity for investors. So let's get started. First up, we've got Greg Smith, CEO of IP Group. Greg, great to have you with us this afternoon. Let's jump straight in. What's the latest from IP Group and why should investors take notice?
So IP Group exists to back, build, finance and profitably exit transformative businesses based on science and innovation. What problem do we solve? Well, many of our portfolio companies are solving some of the world's biggest problems, such as climate change, the burgeoning costs of healthcare and the healthcare system, and the real leaps that are needed in hardware and technology to realize the promise of the fourth industrial revolution. Specifically, IP Group solves the challenge of a lack of capital and a lack of experienced deep tech investors to be able to back, build and develop those businesses and to be able to develop them at scale from the UK's world-leading science and technology. So that's the sort of why do we exist and what problem do we solve? I think crucially, why now? Why would you look at IP Group now? Well, I think it's a very opportune time. Risk has been off in the capital markets for 3 years plus. The UK is seeking to mobilise 2.5 trillion of private capital in long-term schemes such as pension funds, and we have a ready pipeline of scaling businesses. Not only that, scientific innovation has never been more important as a driver of economic change, and even in the volatile world which we currently live in geopolitically and from a defence point of view, it offers solutions to some big problems, but it also gives companies the opportunity to create and disrupt new markets. Specifically around IP Group, our shares currently trade at quite a significant discount to our net asset value. That is enabling us, partly through successful realizations over the recent past, but that's enabling us to operate an active buyback program through which we'll be retiring about 20% of our shares in issue. And the recent market turmoil acted as a point for me to top up my own personal holding in IP Group. So really opportune time to be looking at this as an asset class and IP Group as a specific company. So in a bit more detail, IP Group is a FTSE 250 listed investor, and we have been backing science and technology businesses predominantly in the UK for the last 20 years. So we've got a lot of experience in this sector. We are the UK's most active and indeed the largest investor in UK spin-out companies from universities. A lot of that is done through our award-winning brand Part Walk, through which we manage a lot of EIS tax advantage capital. We develop and support, therefore, many of the UK's most exciting businesses in the science and technology space, and we've built this track record over 20 years. And then some companies that investors might be aware of will include Oxford Nanopore, Ceres Power, and more recently we exited a fantastic Cambridge business called Featurespace to Visa for about $1 billion. So we're building a great track record. Last year was a good track record for realizations. We realized about 180 million from our portfolio, and that has enabled us to have an active buyback program, and also has given us firepower for investing in some of the really exciting pipeline that we're seeing coming through. We are backed by a number of leading UK and international investors. Railpen, one of the UK's sort of pioneering pension funds, is our largest shareholder. And we have private debt from Phoenix Group, which is the biggest backer of DC pension funds in the UK, biggest manager of UK pension DC pension funds in the UK. And we also work very closely with one of Australia's top 10 superannuation funds, Host Plus. In terms of some examples of the types of businesses that you get exposure to through your holding in IP Group, I'll pick on just 2. So the first is a business called Oxa. Oxa is the world's leading software company for autonomy in vehicles for industrial applications. Definitely can be applied to robotaxis in due course, but we see in the shorter term a huge 43 billion opportunity for software operators. This is a business which has been backed by us for a number of years, but also in the most recent Series B financing that the company completed successfully a couple of years ago. And we were joined by people like BP Ventures, Google Ventures, and others to give the business finance to go on the next leg of its journey. And what this business does is it's completely agnostic to the vehicle type, the sensor type, and the environment type. And so this is a truly SaaS type software business for industrial autonomy. Really exciting, 43 billion market and world leading UK technology ready to scale. The second I'll talk about is an example from our Australian business. And this is a spin out from the University of Wollongong in Eastern Australia, between sort of Sydney and Melbourne. And this business has created the world's most efficient hydrogen electrolyzer, a 95% efficient hydrogen electrolyzer. Why is that exciting? Well, it completely transforms the economics of creating green hydrogen. And hydrogen is still, we believe, going to be a major component in the path to net zero. Around 10% of energy needs are going to be in very hard to abate sectors such as steel production and industrial chemical processes. And you need to be able to produce hydrogen at efficient levels. And that business is just at the point of reaching commercial scale, and hopefully over the next couple of years offers a real significant revenue opportunity.
Well, thanks for that, Greg. I guess just to wrap up with, I guess one question that I guess I'd like to pose to you is what key message would you like investors on today's call to go away with?
So IP Group has been known as a permanent capital vehicle listed on the London Stock Exchange, investing primarily in private businesses. Over the last 5 years, we've taken the business on a journey to be a more diversified fund manager. When I say diversified, I still mean we do venture, I still mean we do deep tech, but diversified by pools of capital. We now have £500 million of tax advantage capital doing much of our early stage sourcing. We have about £1 billion of business building capital on our balance sheet, and we have a growing pool of scale up capital. And I think that offers quite a unique opportunity. There aren't any other vehicles like this in the UK where you can get diversified access to some of the world's leading science and technology businesses, high growth private companies, but also have the regular income stream from third-party funds. We are trading at a really significant discount to NAV, and a lot of that is down to risk appetite in the market. There are other factors. I see it as a really interesting buying opportunity. I personally have topped up my holding in recent weeks, and if this is an area of the economy and of the world's global economy that you think should be part of your portfolio, now's a really interesting time to look at getting that sort of exposure. And I'd posit that IP Group is a great way to do that.
Greg, thanks very much for your time today. Before we move on, if you'd like to be automatically invited to future updates from IP Group, please respond to the poll now, and we'll ensure that you stay connected. Now let's move on to our next company. Joining us now is Chris Morgan, Senior Investment Director at International Public Partnerships. Chris, thanks for joining us today. Let's jump right into it. Can you tell us a little bit more about the company and what's driving the business forward right now?
Yeah, thanks, Mark. And it's a pleasure to be here and to be able to speak to investors through the Investor Meet Company platform. By way of introduction, I'm Chris Morgan. I work for Amber Infrastructure, which is the company that acts as the investment advisor to International Public Partnerships, or INPP, an infrastructure investment company that listed on the London Stock Exchange back in 2006. My compliance team has urged me to point you to the important information set out in the disclaimer, and more generally note that none of what you see here or hear here today should be constituted as regarding personal investment recommendations or investment advice. With that said, let's turn to INPP. So what is INPP's purpose? INPP's purpose is to invest responsibly in essential infrastructure assets that generate predictable and consistent financial returns for investors, whilst delivering environmental and/or social benefits to individuals or communities that rely on the assets as part of their daily lives. And the predictability and consistency of the financial returns is underpinned by the fact that we source essential infrastructure assets that are generating, for the most part, long-term contracted or regulated revenues, where the revenues benefit from a high degree of inflation linkage built into the underlying contracts, and the revenues are paid to us by government or government-backed counterparties. So there's a great deal of predictability and security around the underlying revenue streams. We then reduce risk by making sure the portfolio is well structured with good diversification, not just in terms of geography, but across subsectors and counterparties. But what all of the assets have in common is they're all supporting the delivery of essential public services. Amber Infrastructure, the company that I work for, has one of the largest teams in the sector, with a strong focus on active asset management. And it's through this team that the company optimizes the performance of the underlying investments, and it also leverages the wider capability of Amber in terms of sourcing attractive new investment opportunities and running divestment processes, all of which are ultimately aimed to improve the composition of the portfolio. All that we do is underpinned by our commitment to being a responsible investor, and that's demonstrated through our alignment with various different sustainability regulations and frameworks. And it's really all of those factors and characteristics that come together to create a resilient portfolio that is capable of delivering long-term financial, environmental, and or social benefits to stakeholders. And that's been proven out over time. So IMPP was listed back in 2006. And of course, since then, we've been through various different market cycles and macroeconomic conditions. We've had a global financial crisis, Brexit, a global pandemic. We've had various international disputes that have impacted on international supply chains, volatile interest rates, inflation rates, and yet throughout the company's near 19-year history, it has continued to deliver good operational performance, and it's provided its investors with dividends that have grown every year. So that was a little bit about what we're trying to do and how we do it, but what does the current investment case look like? Well, from a financial perspective, the projected net returns are currently 10.8%, with the majority of those returns being made up of the dividend yield, which is currently 7.6%, and the remainder, or the balance of around 3%, is being delivered through capital growth. If you were to put your money into a bank, you might get 3%. You could buy short-dated UK government bonds that might give you 4%, or maybe long-dated UK government bonds that might give you 5%. And yes, IMPP could be considered to be a riskier investment, but actually we think the additional returns that are available more than compensate for the additional risk. In terms of inflation linkage, the 0.7 statistic at the bottom left of the page, that means that if inflation were to run 100 basis points above the assumptions that we use, we would expect a 70 basis points pickup in investor returns. So in a world where there is uncertainty around inflationary projections, we think that's a very important protective mechanism. Since 2006, the fund has grown significantly. It currently has a market capitalization in excess of 2 billion. There are more than 140 different investments spread across 8 stable, developed OECD member countries. The focus on active asset management that I mentioned on the previous slide is a really important feature, and that has helped to drive a very good operational performance in the past. And it's the ability or potential ability for us to further optimize the individual investments as well as the portfolio as a whole that we think could result in outperformance of projected returns. And finally, through our use of the UN Sustainable Development Goals in our wider materials, investors should hopefully be able to understand the non-financial benefits being brought about and supported by their investment in IMPP. So this slide is really a visual representation as to our track record of growing the dividend every year since 2006. The current dividend yield is 7.6%. We've set out targets to grow dividends again over the next couple of years, with our 2025 and 2026 dividend targets being set at 8.58 pence and 8.79 pence respectively. And actually, the existing portfolio, as it is now with no further investments, is forecast to generate sufficient cash flows to enable us to grow the dividend further at 2.5% per annum for at least the next 20 years. Just looking at the net asset value, or NAV, and how that's tracked over time against the share price. And the NAV is really the independent directors' view as to the value of the company, as supported by the investment advisor and as reviewed by PwC, the company's auditors. The share price is, of course, a reflection of the public market's value that they ascribe to the company. And what you'll see from the chart is that from 2006 through to 2022, the share price typically traded above the NAV, apart from a couple of months when we had the global financial crisis and momentarily in 2018. And since 2022, there have been various macroeconomic and geopolitical and other external factors that have weighed on the share price of INPP and other investment trusts. But you can see on the right-hand side of the chart, we are currently trading at a discount to our NAV, but we think the recent share price movements are overdone, and we think the current share price materially undervalues the company and effectively provides investors with a compelling entry point into a stock that has historically been quite expensive. So just looking down into the underlying portfolio, I mentioned earlier, but we have more than 140 assets in the portfolio, and we generally consider them as falling into one of three segments. So we've got regulated investments, we've got public-private partnerships or PPPs, and we've got operating businesses. And if I start with the regulated investments, these make up 50% of the portfolio. There are 13 assets in this category, and they range from offshore electricity transmission assets, and we have 11 of those. We've got a gas distribution business, and we've got the 25-kilometre super sewer that's being built under the River Thames to ease river pollution issues. Now, these assets benefit from monopolistic market positions, and therefore the revenues that these assets can generate is regulated by an independent economic regulator, so Ofgem, the energy regulator, or Ofwat, the water regulator in the UK. And the frameworks that are applied by those regulators differ. So you've got the electricity transmission assets that benefit from 20 to 25-year availability-based revenue streams, to the gas distribution business, where the revenues are set in respect of each 5-year regulatory period. But the frameworks that are used are well-established, long-standing, transparent, and of course the regulators have a more general statutory duty to ensure that the regulated companies can earn a fair return on their capital. Turning to the PPPs, these represent 38% of the portfolio. This is where you've got a concession-based investment, and the nature of the asset can range. So we've got schools to libraries, police stations to courthouses. And generally, these assets will be generating availability-based revenues under contract with local authorities, and there'll be a 20 to 25-year concession period. So as long as the assets are kept available for use, then revenues are paid. The final segment of the portfolio, the operating businesses, make up 12%. There are 4 assets in here. We've got Angel Trains, which is the UK's largest rolling stock leasing business. It leases trains to train operating companies. It doesn't matter how many people get on the train or how many services are operated by that train operating company. The lease payments are due irrespective. We've then got a rail business in Germany. It's an owner-operator, so it owns rolling stock, and it also operates those rolling stock assets to provide regional rail passenger services across Germany under contract with various federal states, again, typically generating availability-based revenues. And then we've got a couple of digital assets. They have a slightly different risk-return profile, but those assets are performing very well. They're building out fibre networks in various areas of the UK, and they make up 2% of the portfolio. And it's really the contractual structure and the regulatory frameworks from which these assets benefit that help us meet our wider objective of delivering investors with predictable and consistent financial returns. So just turning to the outlook, as mentioned earlier, various macroeconomic conditions, geopolitical events, and other external factors have weighed on the share price, not just of INPP, but across the wider investment trust sector. And some of you might be familiar with the company and familiar with some of the actions that we've taken to try and reduce the discount and enhance shareholder returns. But for those of you that aren't, we've sold over £260 million worth of assets in line with our carrying values, which has given investors some confidence in terms of the value that we ascribe to our assets. We've then reallocated that £260 million of proceeds to both reduce risk and enhance returns. So we paid down our corporate debt facility, and we started a share buyback program, and we've also reinvested some of the proceeds into higher returning assets. As part of our 2024 results announcements, we published that about 2 or 3 weeks ago. We set out some additional measures, building on what we've done over the last couple of years, but again, trying to reduce the discount at which the shares are trading and more generally enhance returns for shareholders. Those measures include an enhanced divestment program. So we're looking at selling more assets to provide more support for our valuations and enable us to meet an increased target where we are planning to return up to £200 million of capital to investors over the period to March 2026. We've also set out further dividend growth. So I talked earlier about our 2025 and 2026 targets, reflecting growth of 2.5% each year. And we are switching to quarterly dividends from June 2025. We've also reduced the cost of running the vehicle by changing the basis for the fees that are paid to the investment advisor. So rather than being based on the book value of the portfolio, they will now be based on the average of the NAV and the market capitalization, which reduces the cost and enhances returns for investors. And finally, we do continue to see a good level of opportunities for the company going forward, but we'll be very disciplined in terms of reinvesting disposal proceeds. So we need to make sure that the strategic benefits and the projected returns of any new potential investment opportunity are greater than those implied by the share buyback. We recognise that perhaps not necessarily any one or collection of these measures will eliminate the discount to NAV which the shares are trading, but we believe they will help to unlock shareholder value, and we think it's important to proactively take measures to enhance shareholder value as far as we can. So finally, the underlying assets continue to perform very well against a challenging market backdrop, and that's really a testament to our approach to asset selection, our approach to asset management of our low-risk essential infrastructure assets. We think the projected returns are very compelling at 10.8%, with the majority of those returns comprising the dividend yield, which is close to 8%. Inflation linkage remains an important feature at 0.7%, providing investors with some comfort around the protection of their real returns in a higher inflationary environment. And I talked a moment ago about the measures that we're adopting in terms of further portfolio optimization, asset sales, returning capital to shareholders, greater dividends, and a reduction in cost of running the vehicle. And we believe those measures will help to unlock shareholder value and drive returns for shareholders. So fundamentally, we think the current investment case is very strong, and we believe the portfolio is well positioned going forward. That brings the main presentation to a close, but I'm happy to take any questions.
That's great, Chris. Thanks ever so much. Covered a lot of ground there. I guess one question, I guess, from investors would be about the pipeline of potential opportunities moving forward, and maybe you can just give it a little bit of insight into what that looks like.
Yeah, and I suppose the first point to make is that when we talk about our projected net returns of 10.8%, that's based on the existing portfolio. So we do not have to make further investments in order to deliver our current projected returns. Having said that, I think there are various trends that are supporting a strong pipeline of opportunities going forward. Clearly, governments have acknowledged the need to both repair existing infrastructure and build new infrastructure. And in the UK, the government have talked about infrastructure spending being central to their mission to grow the UK economy. We've got teams across Australia, New Zealand, continental Europe, the UK and North America. And we believe we're very well positioned to take advantage of the numerous opportunities that we think will present themselves over the coming months and years.
Chris, thanks for your time today. Before we move on, if you'd like to be automatically invited to future updates from international public partnerships, please respond to the poll now and we'll make sure that you stay connected with the company. Right, moving on to our next company. Joining us is Dean Heaney, Head of Institutional Distribution, and Mark Payton, CEO of Mercia Asset Management. Thanks to both of you for joining us this afternoon. Let's jump straight into things. Can you tell us a little bit more about Mercia Asset Management and why investors should be paying close attention right now?
Fantastic. Thanks very much, Mark. Mark, maybe we could kick off by you just talking a little bit about how Mercia came about and our journey so far.
Absolutely. Well, I'm fortunate because Mercia is my third business that I had the great fortune in setting up and moving along. And the previous one was venture backed. And I remember meeting a US venture capitalist from a very sizable firm and asking him what was the single most important thing that they focused on. And it was deal origination, which I thought was very interesting. And if you then sort of step back from that and look at the UK, so the ONS, the latest figures they did back in 2021 showed that there were 12,600 high growth businesses. And high growth defined as growing at headcount, actually employment at 20% per annum over 3 years. And of those 12,600, about 21% of those are based in London. But of the money that's deployed in the UK, over 66% of it goes into London. So there's a disconnect. There's clearly opportunities in the regions and there's a disconnect. So Mercia was born, if you like, in the Midlands, where we had this ambition. And actually, you know, the name, for those who are interested, the Mercian Empire started off in the Midlands and grew all the way up to Scotland and through London down to the south. So the idea of setting something up in the Midlands and with an ambition to grow out to the regions and using physical presence in the UK regions as the way to crack that deal origination challenge was really at the heart of the model. And we now have 11 offices across the UK. About 65% of what we see are through our own networks, our live networks. And quite interestingly, a vast majority of the remainder are through quite a sophisticated technology-enabled outbound metric that we use. So most of our deal flow comes from the local networks. And that really was at the heart of what we were trying to do. And you can look at, you know, you step backwards and say, okay, well, when we started this, we started to grow, you know, relatively modestly. We floated in 2014 with about 23 million in third-party funds under management. We've got over 1.6 billion today. Over 12 months ago, we deployed about 240 million, 85% of that outside of London. And in the last 12 months, that's 270 million. So it's continuing to grow. And in that deal origination was at the heart of the foundation for the model.
Yeah, no, I think that's really important. You know, having the boots on the ground, seeing a lot of the deals that others would just simply miss, you know, is really attractive when institutions and investors are looking at us, because, you know, we can become a real strategic partner to some of these organizations that would find it really, really hard to replicate that scale and that breadth themselves. So I think that regional presence, the 11 offices, the people on the ground, seeing all of those deals that come to market is a huge advantage for us at Mercia.
Yeah, and one of the things we set up was our core values. We have these 5 core values, which really threads through the culture at Mercia. And one of those is connected. So rather than thinking of a team of 7 or 8 in Sheffield, think of a team of 130. So we're all out there connected to intermediaries, to advisors. Our track record is a group rather than an individual. And that just attracts deal flow. And we see about 60 to 70% of all deals done across the UK, we have seen. So we're not seeing everything. And some of those are not off market, but we're seeing most, actually. And I do think that physical presence and the human side of it. Yes, we use technology a lot within Mercia, but the human side of networking and accessing opportunities is critical in this industry.
So we do venture, we do private equity, we do private debt. Maybe you could talk about some of the success stories that we've seen in each of those areas.
I've always been a believer that businesses need to access capital. Sometimes management founders not sure what sort of capital they need, and actually that's up to us. And so what we've always looked at, especially on a sort of a regional mindset, is looking at I guess equity gaps. Equity, you know, so where is there a gap in the financial provision that we can fit in profitably to do that? And that could be early, like you say, it could be early stage venture, it could be scale up venture, it could be small debt, larger debt, property finance. We're doing the whole sort of remit of it. And then you look at this, and there are brands now that we have been with for some time that are sort of household brands. I mean, I'm just looking over here. So beautifully, Harrogate Spring. We're a backer of Harrogate Spring Water. We back that business. We've backed them repeatedly as they're going through. Other brands that people might be aware of, Pure Pet back in Newcastle. That's a business growing really, really fast now. That was an early stage venture back, whereas Harrogate was debt that we provided into them. Then there are young business, Isomat, which is a University of Nottingham spin out with a monoclonal antibody looking at treating what is basically atherosclerosis in sort of type 2 diabetics. Remarkable business. We've just backed that business. So young businesses coming through. Kirsty's, if you go into Asda, Sainsbury's, Tesco's, you'll see dairy-free, gluten-free products in there. That's a business we backed as well. So there are businesses across, these are all regional businesses across the regions that we find really compelling. But there's also businesses in London. I don't knock London. We see ourselves as a national investor. where deal origination is about being physically present there. We have an office in London. So Oddbox, which people may be familiar with, that's a business as well that we backed through our London team and is a business growing really quickly as well. So those are some examples. Now, we've got something like 500 active companies in our portfolio. So and within that, about half of our business is venture, approximately. And there's about 260, 280 venture businesses in that. And we are now the most active investor in venture in the country. So because of that, we have a name, we have a reputation, and that attracts opportunities as well. So why Mercia, to your earlier question? Because we get to see the deals that others don't get to see. And do you make money from it? Which is a follow-on question. You know, we over the 10 years since we've IPO'd, we've put about 1.2 billion to work. We've returned over 800 million back to our fund investors. So yes, we do make money. And of that money, still, we've got about 2 billion, 1.8 to 2 billion in assets under management, and a third of that is in cash. So 500 portfolio, strong cash position, growing AUM, profitable exits from previous businesses. So yeah, the regions have great value if you can find them, and they return capital back to investors, which I think is really critical on this journey.
Yeah. So we're making strong returns, but also obviously we're contributing to local economies. You know, it might be the environment, it might be socially we're contributing, we're creating jobs in regions, which, you know, if you put yourselves in the shoes of an institutional investor that's looking to generate local impact or do place-based investing, you know, having that financial return, which is super important as a fiduciary of the capital, but also being able to demonstrate a measurable impact in some of those areas is a real attraction.
No, I agree. We're a listed business, and we're listed. The transparency and governance structures that come from being listed, I think, are exemplary. And that provides reassurance to the pools of capital we manage, as well as our shareholders. And actually, those two very often mirror each other. So about a third of the money we manage is retail, about a third of it is public sector, such as British Business Bank, etc., and about a third of it is institutional capital. I mean, you look at our share register, we have retail, we have institutional capital as well on our. So those things mirror really nicely each other, and that beauty there is that we can provide the right sort of capital. So with retail, it's typically tax efficient, EIS, BCT, for the right opportunities. Institutional is typically in our hands, looking at slightly less on the sort of risk reward metric, if you like, balance, but there's good solid returns coming from that on a yield basis. And then British Business Bank, other local authorities are still looking for a commercial return, but they have other metrics as well. So our number one goal is always return money and meet people's commercial aspirations in terms of that. But actually, because of our passion for doing what we do in the regions, we are backing businesses that wouldn't have got money before. We are financing property developments that wouldn't have got that finance if it wasn't for us. So we are putting to work capital on a commercial basis and doing good on a regional context.
So we're growing, you know, we've been really successful in raising capital. What does the future look like? You know, where do you see us going?
Yeah, so a little while ago, about six months ago, we had what we call a sort of what we do day. Right? Bring the whole team together, there's about 130 of us, and talk about this is what we're going to do for the next sort of 3 years. And we've started this 3-year plan. And basically, we're looking at doubling. We're looking at taking our AUM from 1.8 to 3, our EBITDA from 5.5 to 10, and along this sort of journey. And people will look fairly pale in the audience when I said we're going to double the business in the next 3 years. But actually, if you look back over 10 years, we've over doubled the business every 3 years. So actually, for me, doubling business in 3 years seems completely achievable. And then in 3 years' time, doubling it again seems completely achievable. And if you look at the trajectory, I mean, our recent trading statement that just came out, you know, we've beaten market expectations in terms of our EBITDA. We've had something like $250 million of AUM flow into the group, no redemptions whatsoever in that respect. And then if you look at that AUM that's come through back to the pools of capital, it's retail, it's government, local authority capital, and it's institutional capital. So it's across all three areas that we manage as well. And that money is on a national and on a regional basis. So the one thing that does thread through our growth journey historically and for the foreseeable going forwards is a national focus, very much on the UK. How can we be the best? How can we be the first choice for the investor, the first choice for the investee on a UK context basis?
Yeah, completely agree. And, you know, my vision for third-party capital is that we are the first call for anybody that's thinking about investing in UK private assets.
Absolutely. Absolutely. And it's back to the, what should we get right? When I met that individual in New York so long ago, deal origination, we're doing it. We're doing it really well. So the next stage, Dean, is sales and distribution, is that we have more opportunities to invest than we have capital. And even though we have many hundreds of millions of free cash to invest going forward, we have way more opportunities. So it is now about matching our distribution capacity, if you like, an opportunity with the ever-growing deal origination and opportunities there, which for me is just great. I mean, I'm a Midlands born person. So seeing the Midlands grow, seeing the north of England grow, seeing the south, seeing the UK starting to grow as a hotbed of not just, we often hear this criticism about we're great at innovation, but not commercializing it. We are getting better and better as a nation at growing and commercializing businesses. And it's great to be on the forefront of that.
Dean, Mark, thank you very much for your time today. Before we move on, if you'd like to be automatically invited to future updates from Mercia Asset Management, then please respond to the poll now, and we'll ensure that you stay connected. Moving on to our next company, I'm delighted to be joined by David Bird, co-fund manager from Octopus Renewables Infrastructure Trust. David, thank you very much indeed for joining us this evening. Let's jump straight into things, David. Perhaps you can tell us a little bit about the company and what's driving it forward right now.
Hi everybody, I'm David Bird and I'm one of two fund managers for Octopus Renewables Infrastructure Trust, or ORIT for short. We think that the opportunity in renewables and energy and transition investment is as big now as it's ever been. Building renewable energy generation is the answer to three big problems. Firstly, decarbonisation, but also making our electricity and energy supply cheaper and also more secure, because renewable energy is inherently domestic in nature. It's also a huge opportunity ahead of us. Trillions of dollars of new investment is needed to deliver this transition to a clean, secure, cheap energy source of the future. And our approach to this is very straightforward. We think anywhere where currently fuels are being burnt to deliver energy, we should be shifting to electricity, and we should be using clean wind and solar primarily to produce that electricity. And with ORIT's mandate, we think ORIT is particularly well positioned to capture the opportunity ahead of us. Stepping back and looking at where we as the investment manager for ORIT sit, we're quite unusual in that we sit within Octopus Energy, which most people will probably know as a supplier of electricity and gas to domestic properties in the UK. But actually Octopus Energy is active in a range of different areas across the energy transition globally, including in some of the technology that supports the supply of clean electricity to people's homes. And where we come in is as a fund manager, providing capital to build out the wind and solar projects and other technologies that are key to this transition. And as a fund management business, Octopus Energy Generation has been going for around 15 years and has almost £7 billion worth of energy assets that we look after across a range of countries, initially in Europe, but we now have assets as well in Asia and in the US. So looking at ORIT specifically, ORIT is an impact fund, and we're aiming to accelerate the transition to net zero. But in doing so, we're delivering investors what we think is a really attractive level of income through dividends, as well as capital growth, which comes from some of the value-add activities that we carry on in the portfolio. And we do that through investing in renewable assets, principally wind and solar, across Europe, including the UK and Australia. We see ORIT as being uniquely diversified within the renewable investment trust space. And when we talk about diversification, we particularly mean geographic and technological diversification. We're focused on having both wind and solar because we think that really helps mitigate some of the risks that come with the variability of electricity production. And we think diversification is just as important when you're looking at investing within renewables as when you're looking at your investments more generally. ORIT, we think, is different compared with other vehicles available in the space, partly because of that diversification, but also for a number of other reasons. In Octopus Energy Generation, as the fund manager, we have over 150 people, which allows us to deliver services to that wide range of assets across a range of countries. We're also doing a lot more than just buying existing operational assets and holding them until the end of their lives. We're adding value through funding new construction and in being very hands-on in the management of the assets in our portfolio. We even get involved in projects before they're ready to build, and funding those development stage projects gives us the option to take them through construction later on, if that makes sense. And of course, we're doing all of this in a very sustainable way, with ESG integrated right the way through our investment process from day one. In 2024, ORIT went through its 5-year anniversary. And in that time, we think we've delivered what we set out to do at the time of IPO. We've delivered almost 32% total return to investors on a net asset value basis and generated 4 terawatt hours of clean electricity. And that's avoided around 1 million tonnes of carbon emissions, which would have been associated with the fossil fuel generation that we've displaced. That's like taking 500,000 cars off the road or planting 5 million new trees. And in that 5-year period, we've now developed a real track record of increasing the income through dividends year on year. And our dividend target for FY 2025 of 6.17 pence per share is the 4th year in a row that we've increased the dividend target in line with inflation. The reason we've been able to do that is because the active management and bringing projects through construction has allowed us to grow the output from the portfolio of assets year on year, even as we've been actively shaping the portfolio and selling some of those operational assets. And that in turn has led to higher revenue and higher EBITDA supporting that growing dividend. I'm going to dig now into a bit more why we think some of these differentiators are really important. You can see here on the diversification side of things what I mean when we talk about being spread across different geographies and different technologies, with a roughly even split between solar and wind. And we've done some analysis here into what that means for investors. Whilst the data science behind this is quite complicated, the message is clear. By having a number of different technologies across a number of different geographies, the downside risk and the volatility associated with the investment is reduced. So compared with a single technology, single country fund, we see a 40% reduction in downside uncertainty compared with when you compare ORIT's portfolio. Another way that we add value is through construction. And with our first investment back in 2020, we bought the rights to build a 48 megawatt wind farm in Sweden called Ljungbyholm. And during 2024, after owning it for a little over 4 years, we sold that project, delivering an 11.3% IRR over the lifetime of the investment. And that demonstrates the enhanced returns that you can get from successfully managing assets through construction and then recycling, allowing the proceeds to be used potentially to fund more construction in the future. And we've been very hands-on in shaping the portfolio over the last 2 years. We've delivered over £160 million from asset sales at an average 12% uplift to carrying value. And we've also committed that in 2025, we'll deliver at least another 80 million of sales proceeds to further reduce gearing and to give us optionality on future capital allocation. You can see here another way that we've been very active in the portfolio, and that's through ensuring stability of cash flows through a high level of fixed price revenues, 84% over the next 2 years. And indeed, the growth in the dividend has been supported by the fact that over the next 10 years, almost half of our revenues are contractually inflation linked. Another way that we add value is by those earlier stage investments into developers. These deliver the opportunity to earn higher returns, but we also have the right to take the projects that these developers are working on, and if it's right for ORIT at the time, we can then fund construction, and if not, we can sell them onto the market. We've got 5 developers that we've funded so far, and recently we've announced follow-on investments into 2 of these, being Nordic Generation, who have got a well-advanced portfolio of wind and solar projects in Finland, and into BLC Energy, who are focused on solar and battery storage developments in the UK. So I've raced through a number of reasons why we think ORIT is different. Why do we think now is a really attractive time to invest into ORIT and its portfolio? The first of these is the opportunity that I touched on at the start. We see the tailwinds behind renewables as being as great as they have ever been. There's going to be increasing electricity demand as we decarbonise transport and heating, but also from the rollout of AI data centres, for example. And because we have such a broad mandate across Europe, we can be nimble and find the opportunities and the policy regimes that are most attractive at the time. We've demonstrated a track record of delivering income to investors and a growing dividend year on year. And we're able to do that because of the inflation linkage and fixed price revenues. And we also have the developer investments giving us the opportunity to deliver further capital growth in the future. Where we are at the moment, we see the yield on our share price as being over 9%. And so we think there's a really attractive opportunity to get into ORIT at a time when the sector is undervalued by the market. And we've delivered significant volume of asset sales, all at or above our holding value, showing that the share prices do not reflect the underlying value of the assets. And with that, I'll take any questions.
That's great, David. Thank you very much indeed. I guess you covered a lot in a very short period of time, but I guess one question maybe to wrap up with. I mean, given the impact of Trump's tariffs, what would you say to investors perhaps who are on the fence as to whether the renewable infrastructure as an asset class really has a future, and really why now would be a good time to invest?
So we believe more that renewables has a future, but in fact that the transition to a renewables dominated energy system is inevitable. Clearly, Trump's tariffs are not helpful and certainly are creating some headwinds for the US. But we see that as more a delay rather than something that's fundamentally going to change what the power system looks like globally in decades to come. ORIT actually doesn't invest in the US, so it doesn't have a direct impact, but clearly it creates uncertainty. It may create opportunity, actually, in that there may be equipment that was expecting to find a home from Asia, perhaps into the US, that now can't economically get there, and maybe there'll be equipment available in Europe at more attractive pricing. But even if not, we see political support for renewables in Europe as very strong. We see the uncertainty and how that's been reflected in share prices as creating an opportunity to get into the sector at an attractive valuation. And we're absolutely convinced that the fact that renewable energy is not only clean, but also it is the cheapest form of electricity, and it provides greater energy security and less reliance on importing fuels from countries like the US. That means that the sector is here to stay and has a very attractive future ahead of it.
David, thank you very much indeed for your time today. Before we move on, if you'd like to be automatically invited to future updates from Octopus Renewables Infrastructure Trust plc, then please respond to the poll now. I will ensure that you stay connected. So that concludes today's Spotlight event. A huge thanks to all our presenters for sharing their investment case, and to all of you for joining us today. Now, we want to hear from you, and we'll shortly redirect you to provide your feedback. Your feedback is incredibly important to us. It really helps shape the conversation between companies and investors moving forward. So thanks again, and we look forward to seeing you at our next Spotlight event.